Have you ever pondered why the stock market behaves the way it does? Why does it swing like a pendulum, with prices soaring one day and plummeting the next? The answer may lie in a simple yet profound analogy by Benjamin Graham, who compared the stock market to a voting machine. Picture a bustling election day. Voters swarm the polling booths, casting their votes based on a myriad of factors. Some voters scrutinize the candidate's credentials, their proposed policies, and their track record, making an informed choice. On the other hand, some voters might be swayed by a candidate's charisma, a single issue, or even the opinions of their peers. The stock market, in the short term, behaves strikingly similar to this voting process. Investors, like voters, can make decisions based on factors that extend beyond a company's true worth. Emotions, sentiment, and external factors often drive these rapid fluctuations in stock prices. Consider a profitable, well-run company that reports slightly lower earnings than expected for a particular quarter. Investors, reacting emotionally to the miss, might hastily sell off their stock, causing the price to tumble even though the company's long-term fundamentals remain strong. This is akin to voters rejecting a capable candidate because of a single issue, without fully considering their overall platform and qualifications. On the flip side, a company might announce a promising new product or a strategic acquisition, causing the stock price to surge, even if the long-term impact remains uncertain. This mirrors voters getting swept up in the excitement of a promising candidate without thoroughly analyzing their ability to deliver on their promises. But here's where the beauty of the analogy lies. Just as the true value of a candidate emerges over time, so does a company's intrinsic worth. The stock market might behave like a reactive voting machine in the short term, but in the long run, it transforms into a weighing machine, reflecting the underlying strength and value of a company. Benjamin Graham, a staunch advocate of value investing, emphasized the importance of looking beyond the market's voting. By focusing on a company's underlying assets, earnings power, and growth potential, investors can identify opportunities where the market has mispriced a stock, just like discerning voters who see the potential in a candidate who might not be the most popular at the moment. So as we navigate the twists and turns of the stock market, let us remember this insightful parallel. The market, like a voting machine, can be swayed by sentiment and emotion in the short run. But in the end, reason and analysis prevail, revealing the true worth of a company. Taking a long-term, value-oriented approach, rather than chasing short-term market movements, might be the key to succeeding as an investor. So next time you're caught in the whirlwind of the stock market, remember, it's not just a market, it's a voting machine. And like any election, it's the informed voter who often comes out on top.